Hey everybody, Joe here from Avalon. In this video, I'm going to tell you about a useful tool that can save a bunch of tax when incorporating your business. I'm talking about the Section 85 rollover. It's a very official sounding name for this pretty simple strategy. But although it's simple, I would estimate that over half of accountants don't fully understand when and why it should be used. So stick around for the explanation and you'll be smarter than your average CPA. I'll explain what a Section 85 rollover is, when it should be used, and how to complete the paperwork. I'll throw in some examples as well, so stay tuned for that. So all that and nothing else coming right up. Section 85 rollover is an income tax election that can be filed. The name comes from the section of the Tax Act where the election can be found. And I highly don't recommend reading it, just keep watching this video for the important bits. So the election lets business owners transfer property, typically business assets, into a corporation without triggering taxable gains that may otherwise occur. It basically boils down to don't pay tax now, maybe pay tax later. So if you've been operating your business as a sole proprietorship and have determined it's about time to incorporate, then this video is for you. If you're not sure whether to incorporate, check out this video right up here to get the rundown on when you should incorporate your business. Super great video, so go check it out. All right, so how does it work? You might be asking this question, how does the Section 85 work? Well, a sole proprietor incorporates his or her business and assets are basically sold to the corporation at their fair market value, at least as far as CRA is concerned. So this can trigger gains if the assets have increased in value. Now this is a common scenario for businesses that own land or have built up goodwill over the life of the business. So we'll talk more about goodwill in a second, but the Section 85 can reduce personal taxes owing potentially to zero when the assets are transferred from the sole prop to the new corporation. However, it doesn't eliminate tax forever, so that's something really important to understand. The tax liability is simply deferred until the assets or shares of the corporation are eventually sold to a third party. So there are a number of reasons why a taxpayer might use a Section 85 rollover. As I just mentioned, sole proprietors can defer taxes when incorporating their business, but the strategy is often used in estate planning, which is a larger topic for another video. It can be used to defer taxes when transferring assets from one business to another as well. And sometimes business owners want to crystallize capital gains. This just means triggering taxable gains now instead of waiting until the asset is sold in the future. The most common reason for using a Section 85 rollover is to defer taxes when incorporating a sole proprietorship, so we'll focus on that scenario in this video. So let's look at a couple of common scenarios when a Section 85 rollover can be helpful. We'll look at incorporating a business where goodwill already exists and incorporating a business owning land that has increased in value. So the first scenario we'll look at is when you have a sole proprietorship that has goodwill. So what the heck is goodwill? If you've been operating a sole proprietorship for a while and you've built up a strong reputation, then you've likely created some goodwill. For example, goodwill could be in the form of a customer list or subscribers to your service or newsletter, something like that. After incorporation, you are essentially carrying on the operations of that same business. So the goodwill transfers over and continues on. You've technically transferred your goodwill to the new corp. So some examples where you may have goodwill include if the business has subscribers to a service or a newsletter, a customer list that is tied to the organization and not just an individual. For example, an accounting firm might have a list of trusted clients that are expected to remain if the business was sold. Patents, trademarks, all those things will be a part of goodwill. Website content also that generates revenue, such as written information, videos, online courses, that stuff is all goodwill as well. And sometimes it's simple brand recognition. Customers come to your business based on your reputation. That is goodwill. Where a business has built up goodwill, you can use a Section 85 rollover to transfer that goodwill to the corporation without paying any tax. The basic idea is that you elect to transfer the goodwill at a nominal amount, say $1, instead of its fair market value, which could be way higher, much higher. So you might pay tax on the gain of $1, but the alternative could be taxable gains in the thousands or higher. So after the transfer, the company owns the goodwill with a cost base of $1. No tax is paid on this initial transfer to the company, but tax may be paid in the future if the corporation is sold or the Goodwill asset is sold. It just takes a quick chat with your accountant when you're incorporating to get an idea if Goodwill exists in your business. From there, you can have your accountant or business valuator help you understand the value of your Goodwill. They'll work with you and your lawyer to ensure there's a proper transfer of the Goodwill to the corporation. So check out the link in the description below for a detailed, number-filled example of a Section 85 used to defer tax from Goodwill. So in scenario 2, we'll look at a Section 85 rollover used to defer capital gains on transferring land into a corporation. In this scenario, our protagonist, Tito, has a sole proprietorship that owns some land in northern BC. The land was purchased for $100,000 but is now worth closer to $500,000. Tito plans on developing the land and wants to incorporate to do so. So if Tito incorporates without using a Section 85, a capital gain of $400,000 would be triggered. That's $500,000 minus the initial $100,000 cost. That means a tax bill for Tito of about $70,000. Not ideal timing because Tito needs the money to develop the property. Here's where the Section 85 comes to the rescue. Tito talks to his accountant and they use a Section 85 election to transfer the land at its initial cost. The land is transferred to the company at the value of $100,000, which is the same as Tito purchased it for in the first place. That means that there is no capital gain, but the corporation that has the land now has a cost base of $100,000. Now Tito can use this money to develop the land instead of paying money to the tax man this year. The company will likely have a gain when the land is eventually sold. A small side note here, if Tito had some capital losses to use up, he may elect a different amount at this time to trigger that capital gain to offset his past capital losses. He'll still pay little or no tax, but he's effectively used his past capital losses, which is a good thing. Next up, we'll talk about how to complete a Section 85 rollover. Filling the election and completing the T2057 is something that business owners should seek professional help with. However, it is useful to understand the steps in the process so you're prepared. So the first step is to determine the value of the assets owned by the business. Is there any goodwill? Does the business own property that is increased in value? If the answer is yes or probably yes, then a business valuator or accountant can be consulted to determine the value of the goodwill or the increase in asset value. The next step is to incorporate the new company. This is pretty straightforward and can be done through a lawyer or service like Owner. Check out the video for details on how to incorporate a company with Owner. That should be right up here. We've also got an article on how to incorporate a business linked in the description below, so you can check that out. It's important to also consult with a lawyer here when you're using a Section 85 rollover, as they'll be able to make sure that the share structure is set up properly to achieve the desired result. Shortly after incorporating the new company, all of the property necessary to carry on the business should be transferred using a Section 85 election and should be documented with a purchase and sale agreement drafted by a lawyer. So this is done by completing and filing Form T2057 and having your lawyer draft the appropriate purchase and sale agreement. We have a detailed example on how to fill out this form linked in the description below as well. The form lets you transfer the goodwill or other assets of the company at a lower elected amount instead of the fair market value. This can then defer or decrease the capital gains incurred on incorporation. Filing the election can result in a small amount of capital gains, like in our previous example where we had a capital gain of $1. So while it may sound silly to declare a $1 capital gain, it is still important to report the $1 capital gain in the year that it occurred. Now there's your CPA PSA. So one last question I'd like to cover before wrapping up. Should a Section 85 election always be used to incorporate a business where goodwill exists? The answer is no, not always. I'll get a bit technical here, but I know you can handle it. In some cases, it could be argued that the entire brand reputation of a business is tied up with the owner individually. Therefore, the built-up goodwill would be worthless to an outside purchaser. That's nothing against the business, it's just a fact that nobody would buy that because it's wrapped up. So just a disclaimer before I get into the example here is that Paul wrote this next example, so just keep that in mind. So let's say that I ran a business as a hair model. Theoretically, I've built up a large client list of super loyal Joe's hair enthusiasts. Well, in that case, I probably don't have any goodwill because the client list doesn't exist without this Swayze train. Without any value attached to the client list, there's no capital gain to defer and no need for a Section 85 rollover. So there you have it, a topic that is common but not well understood, even by accountants. Now that you have an understanding of this strategy, you'll know to reach out to your accountant and lawyer before incorporating your business, especially where there's some goodwill there. You might save yourself thousands of dollars in capital gains tax by doing so. So if you hear of other fancy sounding tax terms or strategies that you would like us to discuss, please leave a comment below. Happy to hear those. We really enjoy trying to bring clarity to this stuffy and often overcomplicated subject of tax planning. And if you've enjoyed this video or it's been helpful for you, please hit that like button. And if you like content like this, small business owners in Canada, please consider subscribing. We really appreciate your support. So thanks again, and we'll see you in the next video. Cheers.